Last weekend, I skipped the market update video because just the way the market was, it wasn't necessary to do another one because basically the sentiment was same as a week before. So I kind of want to see how the market is going to behave at certain levels. And today, market plunged another 7%. So I decided to do this video. It will be a breaking report. So let's talk about, so when you start to see market plunging like this 20%, and we saw something similar, right? We saw something similar in December, right? You can see that right there. That was a late December 2018. We saw the 20%. We're actually coming down much faster than December at this point because you can see December, it took about 3 to 4 months, and this feels like it's been coming down like this in just about a month or so, right? And it's coming down much faster rate than it has been or it has done in late 2018. So I think what happens is when the market comes down this fast, this furiously, and then first thing is panic, right? First thing you're gonna find out what most traders are doing is panic, right? You're gonna find short sellers pretending to be happy when they've been trying this for so long and not able to. And you can see the thing about that is because the market is actually conditioning traders. I am okay. Just for the record, I am still bullish in the long term. I have not closed any of my long position. I haven't added anything today though. At this point, I'm actually waiting for the market to improve as far as the trend is concerned for me to add more. But I have not closed out any of my longs, just like I did not close out any of my longs when 2018 happened, and just like I didn't close any of my longs in 2016 lows, and actually also accumulating at these levels here. And same thing happened here, and I bought some more here, and so I've been aggressively adding them the dibs since early 2016, and I'm holding all of that today. I have not closed out any. So when the market is pulling back this fast, this furiously, I actually think it's a bit fishy because you're gonna start to hear all kinds of headlines talking about how this is the first time we've seen this kind of raid since 2008 or something like that. I tell you what, I've heard the same thing in 2018. I tell you what, I heard the same thing back in 2016. It's always, this is the worst since 2008. It's the worst since 2000. It's the worst since 1987. I've been hearing it on every steep pullback. So, and some of you are going to say like, okay, one day they're going to be right. Right, but how can you bet on one day, right? How can you just wait for that one day to happen? You can't. Because if anybody's betting on that one day to happen, they already got wiped out. Anybody who's waiting for a major crash since 2012, 2010, they got wiped out because we actually never saw a recession, never saw a bear market, a real primary bear market. Despite the fact of what people say, we were never in a bear market. People don't understand what bear market is, right? Bear market is about 35 to 50% correction. It happens in a span of a year and a half. We get into a consistent selling for a year and a half. Cultivating lower highs and lower lows. That's a bear market. When you look at this chart, I know this is a monthly chart. Most of you probably not even familiar with the monthly chart because most of you probably don't even look at monthly chart, right? And that's the problem. So when you look at this chart right here and looking at this, are we still, as of today, in a primary term uptrend, right? Trend is assumed to be in effect or valid until it gives us a clear signal that it has been reversed. Are we, as of today, can it change? Yes. Can this uptrend turn into a bearish downtrend? Yes. But as of now, as of today, as of right at this moment, are we still in an uptrend? Yes. How can we know that? Well, there are two ways of knowing it. The definition of uptrend is higher highs and higher lows. So we got the high. And when I say primary, I mean primary. This is a primary trend. This is intermediate trend. And the minor, obviously, we can't really distinguish minor on the monthly chart, but minor would be, I don't know, to your 50-day moving average. That will be minor. But this is how I look at it, and this is how everybody should look at it. And I think this is how majority should look at it. But most people are very short term, so they don't look at it this way. When they say primary, they actually think like last several months. That's actually no. When I say primary, I mean last 10 years. And when I say secular bull market, I mean last, I would say when I say secular and secular something, it means, because usually, the market gets, it's like a 20-year secular bull market and 20-year secular bear market. So when I say secular, I mean looking at the last 100 years. But anyway, and then there's like, I would say something like major primary. When I say major primary, maybe I'll go all the way back to 1990s, right? But anyhow, so looking at the primary term, you can see that there are two ways of looking at. There's two ways of identifying higher uptrend, right? That's higher highs and higher lows. So you can see that was kind of a major correction. I believe that was about 20% there, and this was a 15%, two 15%ers. And then this was 20, and then we got another 20, right? So you can see there are major corrections along the way. And that's what the market does. We understand that. We know that when you're in a primary term uptrend, along the way, you're going to see some sharp declines. So how do you identify primary term uptrend? Is that you understand these peaks. That's what was a 20%. That peak, right? That we saw two 15%, and we see this peak where it's a 20, and we saw another peak there. So what do you call these? Well, you call them higher highs. What is lows? So you can see that that's the lows. You can see that that's the lows there. That's lows here. That's lows there, right? So you got the higher highs. As of today, as of now, as of this moment, right? Do we have well-defined higher highs and higher lows? Yes. Well, I have to kind of change the statement a little bit. We've been having higher highs, higher lows. We also do have established higher high because that high is definitely higher than this high. But as of today, we do not have established higher low. It is assumed to be higher low because we don't know how the market is going to behave here. And some of you are going to think, well, this time's different, okay? This time is way different because we're going to get an actual bear market this time. Well, some of you who's saying that today, you've been saying it here, you said that here, you said that there, you said it here, 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 you said it here. You've been saying it every single year since 2011. So whatever you're saying, it has no value, right? So people who said the same thing here are saying it now here. People who said the same thing here are saying it now here, right? So we don't know. So what I want you to do is not look at this market emotionally, not listen to what everybody's thinking. Make your own conclusion. As of now, as of this day, as you look at this data, because I just screened this earlier today, when you look at this, do we still have uptrend intact as of now, as of this today, as of this moment? I'm not saying what's going to happen tomorrow. I'm not saying what's going to happen next week. I'm not saying what's going to happen next month. But as of now, as this time, as of this day, do we have primary term uptrend? Yes. Right? Another way of identifying uptrend is looking at a long-term moving average that has been served as a strong support in the past. Can you agree with me that this moving average that you see in this chart, this right here, that pink dotted moving average, is that a strong support? Well, because 2010 support, yes. 2011, 12, yes. 2015, 16, yes. 2018, yes. We're back here. And does that mean that it's 100% guaranteed that this support, this moving average is going to hold this time? No. But do we have to give benefit of the doubt to the primary term buyers at this point? Yes or no? Yes. Because if you said this is bearish, you said the same thing in 2018, you said the same thing in 2016 and 15, you said the same thing in 2012 and 2010, and you're right every single time. So you can see that I'm not saying it's going to hold. I know it, I see it, I guarantee it. That's not what I'm saying. What I'm saying is, as of today, as of this moment, is this the level that we want to give benefit of the doubt to the primary buyers? Right? I mean, you can see here, you see that long wick. We previously, in 2018, we breached it. So we're just right at it. That's when we may come lower. So we wouldn't be able to find out. We would have to wait maybe another month or two to truly find out if we actually found support. I will update you guys on this chart as we go forward. But as of today, as of this moment, I want to give benefit of doubt to the buyers. And again, you guys know that I've been saying this since the early 2000s. I'm a long-term investor and I'm a position trader. My time frame is much, much longer. I hold stocks at least 3 to 5 years, right? And my trade time frame is much, much longer. So when you look at this level right here, is this the level to start assuming that we're going to see a bear market, a recession? Because if you're assuming that, you assume the same thing in 2016. And you missed out the huge rally that we saw in 2019 or 2018, right? That's 2016. So if you assume this here, you assume that in 2018, you missed out this huge rally in 2019. You assume that here, you assume that here, you assume that also in 2016, you missed out this massive rally in 2017 and 16. And if you assume that here, well, you missed out 3 to 4 years of bullish run, couple years bullish run, 1 year bullish run. And I'm not sure exactly if we want to see another great bullish run, but I want to give benefit of the doubt to the buyers as of today, looking at things long term. Short term is bearish, yes. Minor term, bearish, yes. Intermediate term, I would also categorize today as bearish. Primary term, however, I still categorize. I won't even categorize this as neutral yet. I'll categorize as bullish. Just like I categorized 2018 December was bullish, primary term categorized 2016 lows as bullish. In a primary term, same as 2012. I actually, and you've seen my last video that I done a couple of weeks ago, the breaking report, right? This one, right? Coronavirus 2020, the survival guide. And obviously the video you're watching will be part 2. And if you haven't watched the first one, you can go and watch it. Higher lows, we just established that. Also, you can look at the trajectory of this moving average. This moving average is what? Is on a rising, right? We're not below the move. It's not coming down, right? We're actually rising. We're not really flattening out either. And the price is actually staying up above it, right? And looking at the down here, there's an oscillator here that I put together. This oscillator, this level has been acting as support. So at about 45-ish level, right? In this in this oscillator. So, and you don't have to use one. They're all oscillators that you can use. All they do is just give you certain levels. That's all you can really. That's what oscillators really do, and they're all a little bit all same. I mean, they're all a little bit different, but what they're accomplish is they're all same. So whatever oscillator you use, you just gotta, what they're trying to do is like sometimes they give you overbought, oversold levels, but also give you levels of support at the same time. But you can see here, this oscillator, you can see that we're finding support in this middle ground. The reason is because you can see how this oscillator is not coming all the way back down to where? The bottom of the band, but it's oscillating back and forth at the top of its band. Why? Because we're on primary time uptrend. Last time we did come down to this level, you can see there highs and lows. When market actually crashes, it actually breaks below that, right? The middle ground, you can see that right here. And that's the level when this thing actually broke, when the moving average, okay, the price got below the moving average, as you can see right there, right? That's the moving average. Price got below it and got rejected. But also you can see that oscillator actually broke below. We got up here to retest, but got rejected, and that's what the recession came, right? And then price stayed below the moving average. This is why you can see that in 2008 and 9, when price came down, the oscillator came all the way down to the low at the same time. Do you see that? So here, you don't see that happen. We're actually holding this level. It's been holding there since 2008-9. So we're back at this juncture. And you look at this as, well, this time's different. Again, if you say that this time's different, you said it here today. If you're saying it here today, you're saying the exact same thing in 2018. You're saying it in 2016, 2015. You're saying it in 2013. And you said it in 2010. And every single time you're wrong. So don't be saying that to me this time's different, because people have been saying that to me since 2016. That this time's wrong. Because I'm pretty sure I sent you guys, I shared this exact same chart in one of my videos in 2016. I'm pretty sure. I sent this exact same chart and also tweeted out. I even had I posted in my blog as an article. I tweeted out on Twitter. I posted on my blog, and I made a video on this. In 2015, I said the exact same thing I'm saying today. I want to give benefit of doubt to the buyers. That's what I was saying. And we're back at it. I actually don't think this is a coronavirus that it's doing. And then media is going to obviously, kind of put that in the equation to kind of make a story out of it. I don't believe so. I think there's a psychological reason behind it, but let me prove it real quick here. This is the Dow Jones market data here. So you can see there is all the viruses and crazy stuff that happened throughout the history of stock market. Only 2 times when there's some kind of virus outbreak happen, you can see that 6 months change on the S&P minus 0.3, which is nothing. Pretty much like move sideways. This one's actually plus. So basically, if you look at 6 months change on every single outbreak, right? Every single one of them, we got HIV, got this plague, got SARS, avian flu, this one, swine flu, that one, MERS, Ebola. I remember Ebola. This one, Zika, all these flus I can't even pronounce. We have so many of them. 6 months change. And again, I'm not saying that's what's going to happen, because I really don't think we're seeing this kind of plunge because of coronavirus, though it's happening right now. Because think about this. Back in 2008 and 9, when we saw the financial crisis, right? When we saw the financial crisis back in 2009, swine flu, right? Swine flu occur April 2009. That was actually, okay, so this is 2008 and 9, right? We did this, and then we plunged, right? And then 2008, we kind of bottomed. We started going back up, right? We kind of going back up. And then swine flu happened right at that level, April 2009. So can you imagine? I want you to first understand this. Think about the condition. Think about the environment. Think about the climate of the market. It's extremely bearish. It is very, very fearful. We've just witnessed this whole world might go to nothing, right? Just huge financial crisis. These mega companies are just filing for bankruptcy. They're just going down. They're just falling, right? Like Lehman Brothers went bankrupt. AIG is in brink of bankrupt. Bank of America. Everything, just whole financial capital market of the world is just all collapsing. That was 2008 and 9, which is just extremely, extremely difficult environment. And then to make it worse, swine flu came in April 2009, just about when you think maybe market is finally bottoming, right? And to keep that in perspective, do a little bit of research, swine flu versus coronavirus. Swine flu, at the time, 61 million people were affected. 61 million. And then I believe 125,000 people died. 125,000. Right now, how many people died with coronavirus at this point? I don't know, 70, 80 people died, right? So, and how many cases? 120,000 cases versus 61 million. 61 million cases versus 125,000 cases in America, right? And maybe that number changed a little bit, I don't know. But, and some of you are going to say, well, you never know what's going to happen, man. That number's still going up, so, it could go to 61 million, bro. Some people are actually saying that that's just, conjecture. You're just thinking it might happen. But I'm giving you the worst case scenario. Okay, well, let's say 61 million people actually get affected with the coronavirus, and we actually see 125,000 people died. Because that's what happened with the swine flu. American people. Market rose 18.72% in 6 months, and by the year happened, 1 year later, S&P rose 36%. And that's in the most severe downtrend. That was actually bear market. And fundamentally, market, economy, horrible. Horrible. So don't be saying that, this coronavirus thing is going to crash the market. It won't. And I believe that I don't know, 6 months later, a year later, nobody's going to talk about it. Do you guys remember back in 2016? You guys remember 2016? Everyone was talking about North Korea. I mean, like, I had friends coming to me, it's like, we're going to short the market heavy because, Kim Jong-un is going to nuke America. And with this fear, market could crash like 30%. And then, like, people are sharing, like, the other day I saw somebody sharing and people all retweeting, like, in China, these guys are wearing this like white hazmat suit, with the helmet and stuff, and they're like spraying this antibiotic like spray like stuff in the streets, and then people are like tweeting, retweeting, and people are saying like, oh, this is normal. That's how stupid people are. Do you remember what happened in 2016? I mean, do you still remember? Back, people were tweeting their clip of North Korea marching, like their army, their armies and like Marines, they're marching, right? How the North Korean march, like all like together, like their legs going up together, guys march with tanks and stuff. In the background, there was this like song, like North Korean song, like they're singing like they're gonna kill America, like America's their arch enemy, like that was that song, like Hate America song, and then they're like retweeting this. Everybody was like thinking, oh my god, like, that was 2016. That was right here. So what happened? Why isn't anybody talking about North Korea? Do you really think Kim Jong-un, if he's actually developing a nuke, or if he actually had a nuke, he think he's planned, like this guy's been planning his whole life to maybe, if he's gonna kill us all in America and nuke us, he's all of a sudden 3 years later, he's like, okay, now that's not a threat anymore? You see, every year, man, there's always something. There's always something going on. I mean, we did face 50%, 15% correction, 2015 and 2016. And market went up. We faced a 20%, and we're facing another 20% back to back. And I get it. We're in a market environment has been very, very difficult because, like I said, if you close out your positions in December, 2018 December lows around that area, and then you waited, this is what I say. I always tell you guys, if you chase, you get punished. So you close out your positions up here with loss, and you already took a loss. You close it out because you wanted to wait till market, because you were scared that this was going to get into a bear market. So you close it out somewhere here near the lows. And then you're like, I got to wait until this thing, the danger, right? The danger subsides. So then you went long here. So because, you close out your position up here, you're not going to go full-blown bullish again until it clears it. So you think this is all clear signal. You went long, full-blown bullish. Now you're getting hit. So you're getting hit twice. Here, you got to hit it here. You got to hit there. That's what market is doing. And I'm going to end the video with this. Before the major bullish run happens, maybe similar to what happened in the 1990s, from 1990 to 2000, right? If you go back and check, secular bull market gets into these pullbacks, right? We get 15 and 20s. Usually that's pretty sound rate, like 20 here, 10 here, and then 15 here, 15 here. I mean, this 15 happened twice, so actually the effect was much bigger because 15 and then 15 again. Went up and 15 again. So it's like, it's even though like it's only like if you measure it from here to here, that's only 15. But because it was a 13 and 15, I think, because it happened like month after month, like the effect was actually pretty severe. A lot of stocks were tanking in 2000. I actually think 2015 and 16, the sentiment was much, much worse. And then we get a bear and bull market again, which was very, very smooth. and then we pull back, we get another year of run. What happens is at this one, especially for the fact that the prevalence, the prominence of charting softwares now, that anybody can get a charting software, all these people coming out with stats nowadays, people sometimes can see a lot of these things happening. They look at that and say, you know what, look at that, cleared it, bullish man, cleared it, bullish man, oh, cleared it, it must be bullish this time also, because hey, look, bullish, look, bullish, look, bullish. So what happens is market likes to mix things up just so that for those people who are chasing it, for those people who are, you know what I'm saying, like who are haven't gone long before, but now they're looking at these things and like, oh, I think that's a good time to go long, you know. And people who got out here, they're chased it up here. People who's been bearish for many years, they finally want to go long now after 20% correction. Because people think, well, 20% correction, great. But we saw V-shaped reversal. Okay, now we're fine making new all-time highs. This might be great level to go. They start chasing it. Bears turning bulls, you know, cash people turning bulls, whatever might be, and then I think similar to what happened in 2018 here. I really think these two instances that we're seeing, especially 20% back to back. 2018, late 2018, 20% in a straight down move. It wasn't like conventional correction where it kind of hangs there a little bit, maybe form a topping pattern, triple top, head and shoulder, or something before pulling back. Because a lot of times that's how market likes to correct. It hangs there a little bit and then pulls back. This is the first time, I think, since 2009, the market is coming down without notice. It just goes up, comes down, goes up, comes down, right? Without any kind of hang time, any kind of topping pattern, right? But when you study the global, but when you see the secular market, when you understand the secular market of things, secular trend of things, what happens is before a big run, and I think there are other scenarios too, but what comes to my mind is 1990s to 2000. Before a big run, market is going to make sure at least amount of people going to be part of the market, right? So what happens is market is going to do something crazy. This is pretty crazy because we got 20% and then we see another 20 year later. That has never happened in the history of the stock market, never. Not 20 and the year later another 20. It never happened, but market has to do something like that to keep people out. And plus market has to do something different because market is insidiously clever. So nowadays, everybody got all these statistics, right? So you might come with a statistic where, well, when you see 20% decline and then market makes new all-time highs, well, 9 out of 10 times market went higher. That's probably true, maybe even 100 times in the market. So market knows that you guys are now more prominent with that stuff, with the statistics, man, with your charts. You know, 5-10 years ago, nobody was looking at these things. 5-10 years ago, nobody was looking at charts. Now everybody got charts. Everybody got charts on their phone, laptop, tablet. It's all free now, right? You got free charting software everywhere. You got all these statistics you can get everywhere. So a lot of people are just kind of trading off of that, and market has to do something that it has not done before to defeat your stupid little statistics and now it looks the danger seems subsided now that we made all-time high because in the past it did that, right? And then people chase it up here. Market has to do something to what? To wipe those people out. Because market is going to reward those true bulls. The market is going to reward them. But they're the weak bulls, the new bulls, the weak hands, right? And market's gonna make sure to punish them first. And what's gonna happen is this: we're seeing these abrupt sell-off, 20% back to back. Never seen something like this, and not in this sequence ever in the history of the stock market. And like I said, market is insidiously clever. So what's going to happen is this. I believe good year is going to come. I'm not saying this is exact bottom. Nobody knows where the exact bottom is. But once the market recovers from this, which I think it will, what's going to happen is, as the market thrives, people are going to remember what happened in 2018, late 2018, and then what's happening right now in 2020, early 2020. Just abrupt. It never gave us any kind of warning signal. It never gave us any kind of topping pattern. It never really hang there. It never consolidated either. It just dropped just crazy, like boom, boom. It just dropped every single day, right? So as the market moves higher, what market has already done has conditioned traders and investors to fear. So when the next run comes, most traders, 95% traders, are going to be very, very skittish. They're going to be fearful. Most traders are going to become nibblers and scalpers and day traders and swing to very, very short term because they're scared that I don't want to face another 20% drawdown again, man. And that's when I think market is going to truly thrive. And this is what happens. I think from what I studied, when I study the history, this is what happens. It gives you a scare for a year or two, and then market really gets up. And people still remember what happened because it was such a agonizing, core shaking kind of decline, right? That people are they're very scarred. And so as the market goes higher, every time each market starts to make a uptrend, they'll be scared that they might be met with something like that. And so they're going to close out their position waiting for maybe steep decline. And this time around, steep decline does not come. I'm saying that something like that could happen. I believe that psychologically speaking, that's what the market is setting up for. Right? So let's see how market plays out throughout this week.